Well, hello, my friends. Welcome. We are at the first night of our Live at 5 with Friends, and you can see I already have my friend Bill with me. So thank you so much for joining us. You guys know the drill. If you have any kind of questions or comments, you're welcome to put them in the chat. But I'm going to warn you, I might let a few of them slide by. I'll get to them. But I'm really interested in what our guest, Bill King from ABA Advisors, this is his website, but I wrote it down, it's Accountants and Business Advisors. So welcome, Bill. Thank you so much for joining us. And just so those of you that are watching, you don't know, Bill is the tax guy, but not the bad kind of tax guy. He's the tax guy that's going to help us be able to make sure that our business accounting is right where it needs to be. And we're all set up so that we get to maximize some tax strategies, minimize tax by taking advantage of those tax strategies, and then ultimately increase our bottom line. And I can say that I have worked with Bill and his team for a number of years. He actually has 800 physicians that they do accounting for, over 3,000 clients. So I think he's probably knows what he's talking about. So I'm just so excited to have you here. Thank you, Bill, so much for joining us.
Thank you, Rhonda. That's nice.
Yeah, I'm looking forward to it. So to get started, the first thing I want to know is, what is the biggest difference, would you say, between like accounting needs for healthcare practitioners or healthcare professionals? So is there a difference, or is just accounting and it doesn't really matter?
No, there's a difference because there's different ways they generate income. They have active income from services they render, and then they have capital-based income. Things like surgery centers, optical shops, whatever it may be, product sales. So it's a whole different kind of income.
So you're talking about two. So you'd have like, because our audience are more going to be healthcare practitioners in the functional medicine or holistic space. So they're going to have generally two sources of income. We would have fee for service income, and then we would have things we sell, the things and stuff that we sell. So is that what you're talking about, capital-based income?
It is. I mean, active income is subjected to self-employment tax, and capital-based income theoretically is not. So it's a lesser cost, if you will, to have capital-based income than active income.
Okay. So what do you see, generally speaking? And it may not be, because none of my crew are going to have surgery centers or anything like that. They're going to be one-man stores, one-man shop, maybe an employee or two that generate fee-for-service type income, consultation income, and then again they're going to be selling products, services, or being products or supplements or some tangible, in many cases taxable goods. So is that the biggest difference between for healthcare practitioners versus another type of business?
Yeah, the combination of active income and product-based income is a little bit unique, and that's what healthcare, I think, differentiates healthcare from others we serve. Also, there's an opportunity, as I mentioned a moment ago, to pay a little lesser tax on the product sales because they're not subjected to self-employment tax. So making sure that you allocate your profits accordingly is important, and how you're structured is important.
So I want to jump. I hope you don't mind, like, I'm asking questions because I really am interested. So what you're saying is then the right way to account for your income is going to be to have your fee for service income on one line and your product sales on the other line. Bad idea is combining them.
That's right.
Okay. So
you could drop your tax bill unknowingly if you combine them.
Really? Because then you're lumping in the sales of your taxable products in with your fee for service, your consultation income, and then you'd end up paying self-employment tax on both. Now, what is the difference if it's a corporation, an LLC, let's say?
Yeah, let's talk about different entity types because that makes a big difference.
Yeah.
So first of all, the most confusing vehicle, but the most common these days, is a limited liability company. And if you're generating professional income of more than 80% of your income, then you're a PLLC, which is a professional limited liability company. And a limited liability company can be one of four things. It can be a sole proprietorship, it can be a C corporation, it can be an S corporation, or if there's more than one member, it can be a partnership. The PLLC format as a sole proprietor is fairly common, but it's the least efficient of all those. And the reason is 100% of your income is subjected to self-employment tax in that model.
Right.
The other problem is, as you'll see when we get into tax strategies a little bit later, you can't transact with yourself, which is a key component to minimizing tax.
So tell me what that means.
It means if you have a company and you want to rent your car to that company, you can do so unless you're a single member LLC that's a sole proprietorship, and then you can't.
Oh, could you tell us more about that?
Sure. I mean, there's all kinds of different things you want to do to get money out of a business that are tax efficient, and a lot of them involve interacting between the individual and the company. But if the PLLC is a single member entity, there is no differentiation between the individual and the company, so you can't pass money back and forth. Classic examples are automobile lease payments, home office reimbursement for meetings at your home, and other things we'll elaborate on in just a minute.
So when you're setting up then an LLC, obviously we need to get legal advice or legal guidance on the right type of entity for your particular business type or for your business. But this takeaway would be that you don't, if you're just a single person and you're not married, so would it count if you had a husband and a wife as a 50-50 in an LLC?
No, it would not.
Can't do that.
Right.
Okay. So you need to get some legal advice to know how to set that up in order to maximize that tax strategy.
Legal advice may be an overreach. I think if you just have good tax counsel, they'll tell you probably that the PLLC needs to choose to be something besides a single member LLC.
Okay. So then I would say very few of my audience is going to fall under that requirement for a PLLC. Okay. So how is that different than for an LLC or a partnership, LLP?
Well, the same principles apply. You still have to, the only difference between the LLC and the PLLC is the word professional, which means 80% or more of your money came from professional services. So the strategies are all the same there. The PLLC or the LLC should be something other than a single member. You can choose to be a C Corp, you can choose to be an S Corp or a partnership.
Right.
The C Corporation is a little more advantageous recently than it used to be, because now the tax rate on C corporations is 21%, which sounds good at some times. But the problem is when you take dividends out of the C corporation, they're subjected to tax again.
Right.
Capital gains. So you end up with a higher tax bracket typically with a C corp. S corporations are by far the most popular. There's no entity tax, and they're taxed at the individual level. They also facilitate extraction of money 3 different ways. Business-related expenses being the most important, dividends and salary are the other 2 ways to get the money out.
Okay.
The beauty of dividends, pardon me for cutting you off, is shareholder distributions is what they're officially called. They're not subjected to self-employment tax. So in the S corporation model, you might have $150,000 of profit and $50,000 comes out in tax-free business expense reimbursement, maybe $50,000 in dividends or shareholder distributions, and another $50,000 in salary.
Woohoo! That's pretty nice. So you take $150,000 and you're really paying tax on very little of that.
Yes.
At the end of the day. So that's what you guys specialize in.
Yeah, the proper structure is where it starts, and then coaching the client once the structure's in place on how to use it is the next part. But let me comment one more thing about entities and we can move on. Partnerships are the other way to do business, and partnerships involve one or more person in an LLC or a partnership itself. And partnerships have their own drawbacks. The money that comes out of a partnership oftentimes is also subjected to self-employment tax, so that's a little bit of a negative. You also need to guard against the fact that there can be attribution between partners for liability purposes. So for that reason, we don't see partnerships very often. But some larger entities we serve are PLLCs taxed as partnerships. But the reason they do that is because each individual owner has their own company beneath the mothership, so to speak. So each doctor would have their own company, and the partnership would collect all the money, pay the overhead, and then distribute the money to the individual owner's LLC.
Got it. So that would be for a larger corporation, or a larger group. You've got a group of doctors that are practicing together. Yeah.
Right.
Okay. So talk to us a little bit more about tax strategies for like the solo practitioner. Okay. The guy who's working on his own, the gal who's an acupuncturist, she's got her very own clinic. She has no employees, or maybe just a part-time employee. But where do you start with someone like that? Like, where's the first place? What kind of advice would you give them?
The first place we would start would be with entity structure. That person should probably be a limited liability company owner, taxed as an S corporation. And so what they would need to know is how to use their S corporation in that setting. Okay, and this could be a PLLC as well. So there are a number of things that should be done for that individual to get their profit home in tax minimized ways. The first is by taking their automobile into consideration. We don't typically like to have the automobiles owned by the entity because there's so much liability when you have an automobile, and it can take down the entire enterprise.
Right.
But if you own your own car, you can lease it to your business. Probably makes sense to you that you can have a business lease a car from Ford Motor Credit or from GMAC, but you could also lease a car from Rhonda Nelson if you wanted to.
Really? So I could lease my own car. I could lease my car to my business.
Can and should, yes.
And so then do I just invoice my business every month?
You sign a lease agreement, and the business pays the lease agreement just like it would to the vendor.
So the business pays the lease agreement to me, not to the leasing company or the lender.
That's right.
Pays it to me. That's right. Then that becomes a write-off for the company, but I get to keep my car. What about repairs, maintenance, gas, all that stuff?
All paid for by the company in that setting, because anything it's leasing, it has to pay for the expenses for whatever it's leasing. And also back on that leasing income that you receive from the company, it's income to you, but offset by depreciation on your car. So it's essentially tax-free income to the individual as well.
Oh, now how many accountants do you think across the country would know and utilize this strategy? Because what I'm thinking is, let's say we've got doctors that are listening. They already have an established relationship with a CPA. And they say, hey, I was on this webinar and I heard somebody talking about leasing the car back and having to write off and da-da-da-da. How many CPAs or accounting firms are going to be savvy to this?
We hope very few, so they'll call ABA. But I think the answer is not very many. This is not a common strategy, but it is one that's been verified over many years. I've been doing this 35 years, so everything you're going to hear in this presentation tonight has been defended many times over. And the automobile is just one area, but let me expound on that a little bit too. We talked about, you mentioned some of the automobile expenses. We like to have all the expenses of the car paid for by the practice or the business itself, in addition to the auto lease payments. That doesn't mean we're going to deduct 100% of it. We question our clients every year about what their business mileage was compared to total mileage. And that's the percent you get to actually deduct. Now, having said that, I will tell you anecdotally, we send out about 3,000 letters a year telling clients that if they don't respond on the automobile mileage question, we're going to use 90%. And our response rate's terrible. So we end up using 90% most of the time and having to defend that, whether it was valid or not. And let me speak to defending that for just a moment too. One of your questions earlier was about documentation. So automobile logs are talked about a lot by CPAs, but the real requirement is written substantiation, and that can be broadly interpreted to mean your schedule. And if I'm going to defend your automobile usage, I'd much rather have a schedule than an automobile log with odometer readings. It's much easier to defend the 90% if I'm stuck with that than it is actual specificity.
So without saying it, we could just say that we could just go with 90%. Well,
let me help you with how we get there. So another component of this interaction between the individual and their entity should be home office reimbursement. Now, nobody likes home office deductions on a personal return. CPAs shy away from it. We don't like it either. But the way to have your cake and eat it too is for the employer to require space in your home, write you a letter requiring that space, and then you make it available. And you're reimbursed based upon the square footage at that point. So what happens is you get tax-free reimbursement that's non-reportable for the home office space. It's not a lot of money, but it helps. And then in addition, you start and end every business day at your home office. So if you think about your business travel in a given day, it started at your home office, and then every mile you drove until you got back home was a business mile. We'll get on to marketing in just a minute, but if you came home, changed your clothes, and went to dinner, or down to the casino in your case, then you would end up with business mileage going to and from that entertainment spot, as long as somebody there was interacting with you on a business matter.
Right.
So we end up with a high degree of business usage in the automobile setting.
Wow. So that means then that all I have to do is have the entity draft an agreement, right? The entity drafts the agreement that says it requires me as the employee of the entity that I am required to maintain a home office. And then how would we calculate all that out? How do you know how much to charge?
There's a worksheet that everybody should go through. And I don't know if you want to announce this now or later, but I'll go ahead and spill the beans that there's going to be a package available. with all these documents in it for them to use if they choose to. But there's a square footage computation. You basically look at the cost of running the home, and the square footage of the office is the numerator, and the denominator is the total square footage of the house. The denominator, which drives up the percent.
So when the deduction is calculated, that just can't be arbitrary. And meaning, I want to say arbitrary. The documentation that requires the employer to maintain a home office has to be in place first.
Yes, the letter should be written first, and the computation should be done basically simultaneously.
Yeah, got it. Okay, man.
So we have the home office, and we have the automobile. And if your spouses are working with you, the spouse could also lease a car to the practice, so you get to double down on that particular deduction. All the expenses get picked up as well.
If the spouse is working for the business, in other words, getting a salary for the business.
That's right.
Nice. So you could pay your spouse $100 a month?
Has to be minimum wage, but yes, essentially.
Yeah. So, yeah. Wow, that's great.
Very low salary. And there's some retirement strategies related to paying a spouse we'll get into a little bit later. But let me finish some of these thoughts about the optional business expenses. Okay. Another thing that not many people know is that there's a code section called 280A. No one's going to care about that number, but it says you can have up to 14 meetings a year at your home if you're a business owner and pay yourself the same thing it would cost to rent that space somewhere else in your town. It varies by city. Pretty expensive in Vegas, actually. Mm-hmm. Probably $1,500 a meeting would be a reasonable amount in Las Vegas for the 14 meetings a year that you can do. Now, they require an agenda and a roster of attendees, and there has to be somebody there beside your spouse. But that's pretty easy to meet those requirements. Mm-hmm. So that's more money that can be extracted. Again, going back to where I started on the LLC, it's why you don't want to have a single member LLC, because you want to be able to pay those things to you, and you want to have two separate entities involved.
Right.
Marketing activities are broad. It's our opinion that everybody you interact with could be a potential customer, patient, referral source. If you believe that and you document the interaction, we're going to deduct that under the banner of marketing. We have to differentiate that from meals and entertainment, which got 100% disallowed a couple years ago. Our approach on that is that if you're trying to attract new patients, new customers, that's marketing. Maintaining what you had before was meals and entertainment. And so it's a fine line, but we've had success defending that. Also in that arena, if you have a boat, you want to charter it back to the business whenever it's used for whatever it would cost to rent the same boat down at the marina. If you have an airplane, you want to charter it back whenever it's used as well under the banner of marketing. And then if you have a second home that has vacancy in it, you may want to rent some of those weeks back to your business. So all that occurs under the banner of marketing.
Wow.
With regard to travel, everyone knows continuing education is deductible, but what about the ski trip to Colorado? And the answer is it could be. If you interact with somebody that makes you a better business person when you get back home and you document that interaction, at least part of the trip's deductible, the airfare out and back and one night's lodging at a minimum. So we want to make sure we're aggressive with travel deductions as well. And I say aggressive, we want to make sure we coach our clients that this is available to them. We're not aggressive, we're not aggressive. We bring ideas to the table and people choose what they want to do. The next topic I'll touch on is family members. It's very expensive to raise a child, especially in after-tax dollars, if you have federal income tax, state income tax, Social Security tax, and Medicare tax. Much better if the child can have their own income at their tax bracket. There is something called the kiddie tax, but there are a few nuances to it to make it attractive to hire children, for example. Very young ages, you can't pay them very much, but they can be in your public relations material. When they get to be about 12 years old, they can be social media consultants, and they probably will be whether you want them to be.
Yeah, exactly.
Right. You want to pay them for that, usually around $12,000 a year. And then when they get to be young adults, they can be administrative assistants and probably have that salary double.
Yeah.
We want to shift income to the kids at their tax bracket. We also may give them part of our LLC. Now, you have to be careful about the corporate practice of medicine to the extent that applies to your audience. But there are companies that can be established that children can own, and they can receive part of the profits at any age. Some people balk at that and they say, well, how can a 2-year-old own part of my LLC? And the answer is, can the 2-year-old own part of Disney? Do they have Disney stock? Of course they can own Disney stock. That doesn't mean they run Disney. It's the same principle for your LLC.
Right.
To the extent that we don't have something available like employment, or if the employment's not enough because the preschool or the private school tuition was too high, we're going to create companies for those kids. Maybe, for example, we create a management company that's maybe one of the parents is the person that actually works in the company, but the kids don't. And the kids collect a percentage of revenue, maybe 10%. and pay one of the spouses that's running the show and keep the profits for preschool, that kind of concept. And then lastly, that's still not enough. We take the equipment and furniture and the practice and we give it to the kids, and then they rent it back to mom and dad. So those are all income shifting techniques for children and siblings, by the way, and parents sometimes that need money too in low tax brackets. Works just as well for them. In fact, it works better if there's no kids involved, only because the kiddie tax does come into play at a certain level of income. So those are all reasons and ways to use money that we call optional business related expenses that can dramatically drive down your taxable income. If you do it right, between your home office and your cars and your marketing and your meetings and your travel and your paying your children, you should be able to get somewhere around $50,000 to $70,000 a year into your household account with little or no tax, or a lesser tax.
Wow. That's pretty impressive to be able to pull that kind of income out and then be able to funnel it or redirect it into the personal account. That then leaves a tax return that's going to have a lower, quote, taxable income. So what about someone who wanted to use that tax return and go, buy a house or a piece of equipment or something like that? So we're diverting some of the income, making it taxable, a non-taxable. So now what do we do with the tax return that says I only made $10,000 last year?
Well, it may not be just 10,000, but your point's well taken, and it's an ongoing challenge. I mean, tax minimization strategies are directly opposed to banker required and proof of cash flow and those kind of things. But having said that, and having done this for a long time, you can educate the banker before you ever ask for the loan. You can tell them ahead of time, or we can, that when you look at the return, here's what you're going to see. But if you turn to page so-and-so, you're also going to see the home office and the auto lease and the meetings and the marketing and those kind of things that also went into the household account and provide additional cash flow. So it's about educating the lender, preferably in advance of them looking at the returns in a package of some kind you put together, and let them know that's coming. Show them where the money is, basically.
Right. Because it's all there. It's all accounted for on the tax return. It just doesn't look, it's not in the same place that you would normally think of it, which was at the top line of your total taxable income.
And let me mention one other thing that comes into play sometimes in the banking world, but certainly in the tax strategy world. If you're behaving as an S corporation, which means either you were an S corporation originally, you were a corporation and elected to be taxed as an S corporation, or you were a PLLC and you elected S corporation status, which again, we would recommend for everybody who's a single member LLC, then you have the ability to not only pay those business expenses, but you can also take some of your money in dividends to the extent that it's driven by capital. If you remember where we started the conversation tonight, we talked about the fact that there's different ways that income is generated in a given practice. Some of them are the direct services rendered by the individual practitioner or physician. But there's also other employees that generate income. There can be products that generate income. And those can be paid out through distributions or dividends that are not subjected to self-employment tax. So in the perfect model, you'd have, again, to just use a round number, 150,000 of income, and 50 of it would have been paid through the auto and home office and those kind of things. Maybe another 50 in salary and maybe 50 in dividends or shareholder distributions.
Right.
Self-employment tax. So that's why the entity becomes so important, and coaching the individual client on how to use that entity is important.
Because it is going to be so different for every single person. I mean, obviously there's never going to be two situations that are going to be exactly identical. They can't be, because your whole, the layout, your type of income, all that stuff is going to be different.
Family metrics and all those things are different. That's right.
Yeah, exactly.
Outside businesses come into play sometimes. There's all kinds of, everyone is treated individually, of course, but the strategies are fairly generic across all taxpayers. It's just how you apply them.
Right. So I've got, I'm looking at the Facebook group. That's where my eyes have kind of gone here. I'm looking at the Facebook group to see if there's any questions. And we do have someone asking a question. If there is, do you do any kind of evaluation for other for tax returns that have already been filed?
Yes, absolutely. I mean, that's the norm when we meet new clients, and that's quite often. We would evaluate their prior 3 years of tax returns, and hopefully find opportunities to amend them if that's appropriate, and fix them, so to speak, for things they forgot to deduct or weren't coached properly about.
I got it.
And then the review, for what it's worth, in our firm is at no charge. If we're looking at a potential new client that wants us to review their return, we'll do that at no charge and tell them what we would have done differently.
Oh, well, that's really, really nice. I'm going to put up your, here's their website if you guys want to go check out Bill King and his company, aba-advisors.com. And you're welcome to go and check that out, see if there's something there. You like it. It's a great website. I've been there several times. And as I said in the beginning, I actually have been working with Bill and his team for several years. And I can tell you that this tax strategies that he's talking about in real time have saved us thousands of dollars, thousands of taxable dollars. And it's been very easy. This week, Friday, if you opted into this series, this weekend or Friday, after the last interview is done of our Live at 5 with Friends event, you will get the resource that Bill has graciously provided for us. And that is about the how it's all the different information you need to be able to take advantage of these tax strategies. So I'm so thankful that you were willing to do that. That was like awesome. I am looking back through here. So gang, I'm in the Facebook group and it looks like some of the comments are being filtered out. So if you have another comment, I'm in the Clinical Mastery Facebook group right now, but if you have another question and you want to ask it, please post it now, because for some reason I'm not able to see all of the comments. I don't know what the deal is. So, but Bill, keep talking. If you've got more.
I could write it. People a lot of times hearing these things for the first time worry about audits. And it's going to get me audited. And so I want to speak to that for just a moment.
Please do.
Nationally, audits run around 1% of the general population, and the audit rate in our company is under 0.5%. And that's despite giving the advice you're hearing tonight over and over and over again and implementing it. So that's the good news. You're not likely to be audited. The other good news is that we do have audits. We average about 10 audits a year in my company. We get a chance on a routine basis to defend everything I've told you tonight. And the outcomes have been very good. We also teach you how to document along the way to make sure all these things are properly documented, and we're ready when that time comes. But the audit rate's really low. We do expect good results for people that were worried about that. Another little tidbit that has nothing to do with tax strategy per se, but just so you hear this, people a lot of times wonder how the audit rate is so low in our company. And there's two things I think that drive it. One is if you're paying attention to the big picture there, you're driving down your taxable income, so you're less of a target because your taxable income is lower than it would have been otherwise.
Right.
But also, almost all of our clients extend their returns, and people feel differently about extensions. We are big proponents of extensions. The later in the year you file, it seems the less likely you are to be audited. So I'll just leave it at that and tell you that we recommend you extend your return, get it done, make sure you know where you stand, but you don't need to file it until later in the year.
So you're talking about extending the April 15th. So yes, don't file in April, but filing in September instead.
That's right. The government did it for you this year. They pushed it to September.
Exactly. Yeah.
We normally would file in September or October.
Okay.
I'd like to touch on a couple other topics I think the audience might be interested in that affects your tax situation, if I could. And then one that's kind of on the periphery of taxes, but COVID-19 related.
All right.
So the next area I want to touch on is retirement plans.
Yep.
Another great way to drive down your taxable income. I just want to make sure the audience understands the different kinds that are out there. And it's a very cursory overview. Most people have heard of 401ks and 403bs. And in those, there are three ways to get money on deposit. You can part with salary, called the salary deferral piece. There's usually a safe harbor match by the employer. Sometimes there is, sometimes there's not. Most of the time there is. And then there's a third component, a profit sharing plan component that people can choose to fund. So even the solo practitioners of the world that are on this video can understand that they can have a 401k, and if they're under 50 years old, they could put as much as $57,000 in that 401k. And if they're over 50 years old, it's $63,500. So
Time out. $57,000 a year?
Yes.
In a profit sharing 401k?
Yes.
Well, by golly, didn't know it. Keep going.
Yeah, you got it. Another kind of plan that's popular is called a Simplified Employee Pension Plan, or an SEP.
Yeah.
SEPs are limited to $57,000 no matter how old you are, but still $57,000 is available, or 25% of your income, whichever is less. One thing about SEPs that's kind of nice is they can be established after the year ends. A 401k or other plans like that have to be in place before the year ends to be viable. They can be funded later on, but they have to be in place. But an SEP does not. So if we look at your return today and we didn't like what happened in 2019, we could still consider an SEP for 2019.
Because you can form it in 2020
Right.
to retroact back to 2019.
Anytime before the extended due date.
Oh, got it.
Another kind of plan that's really popular for small businesses, especially those that are not that profitable yet, is called a simple IRA. Simple IRA is what it sounds like. It's just basically a glorified IRA. The limits are much lower than 401ks, but there's no reporting requirement. So there's no administration fees, which is kind of nice. And those limits are $13,500 if you're under 50 years old and $16,500 if you're over 50 years old that you can fund into a simple IRA.
Now, can you double dip? Meaning, can you have a simple IRA and a 401k and
no.
You're shaking your head. No, that's what I thought you were going to say. So you got to pick your one that's right for you and then stick with that one. You can't double dip and have a whole bunch of them.
There are circumstances where you can have a 401k at the practice and an SEP funded, but it has to be a different chain of income, a different line of income, a different industry.
Got it.
Then double dip to some extent.
Okay.
And then for those on the line that are having extreme success and have more money than they know what to do with at the end of the year, they may want to consider a different kind of plan called a defined benefit plan, also known as a cash balance plan. Those plan limitations are much higher. You can see contributions well over $100,000 in many cases.
Oh, okay.
So in terms of tax minimization, those are other things that people need to know that are out there and available to them in these LLCs and S corps that they might form.
But obviously you're the one, you can guide someone through all of that, like where to put their money and you know, putting money away for retirement. I think as business owners, like we wear the clinical hat, and you probably know this working with physicians, is that as a general rule, healthcare providers are terrible business people because we get into the field that we're in because we want to take care of people. Right. Not because we are entrepreneurs. Like that's not what we love. Some do. But as a general rule, practitioners don't know how to, we're not good at saving as general, and I'm making a generalization, but good at knowing how to strategize and how to run a business and how to make sure you're profitable and keep your overhead down. So if someone were to work with you, then you would help counsel them on ways, obviously those tax strategy savings that you went over earlier, but even this kind of thing, you would guide them that way. They don't have to decide and then tell you.
Not only that, we talked tonight about tax minimization because that's what the invite was about, but there's all kinds of ways to drive profit in a practice. Driving revenue, collection techniques, proper use of ancillary services and product sales, minimizing overhead is also important. Minimizing FTEs, paying people properly, using allowances whenever appropriate, shopping supplies. I kind of left it off the agenda tonight, but yes, we would help them with all those things and minimizing their income taxes. And to your comment about, you know, my audience isn't very good at accounting. Well, I'm not very good at taking care of people that need better health either. So we all.
That's right. We need each other. That's the end of the story there. That's right.
Right. I'm going to shift gears on you and talk about COVID-19 programs for just a minute.
Yeah.
There are tax implications that people need to be aware of. And those rules have been changing so rapidly that it's difficult for people to keep up. So I'm going to go back to the beginning. I'll be brief on some of these topics, but it started out with the Emergency Family Medical Leave Act and the Emergency Paid Sick Leave Act, which basically said that if somebody was going to be home because they were sick or someone in their household was sick with the virus, or they were home because of school closings or childcare closings, that they were to be paid for up to 12 weeks at 2/3 of their pay. And then the employer was supposed to skip payroll tax deposits until they were whole. However, healthcare professionals, broadly defined, were exempted from that. And as more and more regulations came out, it seemed like less and less of our clients were actually affected by that because they were exempted under the healthcare professionals banner. So I think your audience would generally fall into that category and probably doesn't have to worry about those type things. But if they do, they should be skipping payroll tax deposits right now until they're even. And if they're not even at the end of the second quarter, they can request a refund on their second quarter 941.
Okay.
After that, they introduced the economic injury disaster loans, the EIDLs or EIDLs. And these have had a lot of confusion as well. That's a loan where you can apply for between $25,000 and $2 million. They don't tell you how much to apply for. They don't tell you how much you're going to get. They look at your economic injury and they look at your ability to repay, and then some black box determines how much comes out of that. But in the meantime, they advanced a lot of folks $10,000 on the front end, or $1,000 times your full-time equivalents, whichever was less. So a lot of people have gotten EIDL money that applied, and they're not sure what to do with that. And at the moment, I would tell them it's probably tax-free, though that is a fluid situation. It seems to be a grant. It seems to have no requirement for repayment, but it will be taxable income. So keep that in mind.
Okay.
With regard to the loan most people are talking about lately, the Paycheck Protection Program, the PPP loans, probably most of your audience has applied for those and maybe received them. And there's a lot of confusion about those loans.
Mm-hmm.
In the last few days, there's been a lot of noise made about the fact that you have to certify you really needed the loan to be able to keep those funds, and you have until May 7th to return the loan proceeds if you don't think you qualified. That's a real dicey area that people have to evaluate on an individual basis.
Yeah.
But what I wanted to comment on with regard to the income tax matters are that the loan forgiveness, if you achieve it, is not taxable income, but the expenses that you pay for with the money are also not deductible. So people have been unclear about that, and I think that's fair. It's how it should probably work, but that is what the rule is going to be for those funds. It's also important that those funds are clearly understood in terms of what is forgiven, and that may be beyond the scope of tonight's conversation, but in a nutshell, it's payroll costs to include health insurance and employer-paid retirement plan contributions.
Mm-hmm.
It's rent, which is defined as facility rent and equipment rent, and it's utilities, which are broadly defined as electricity, water, natural gas, telephone, and internet service. So all those are forgivable expenses. You have to spend them during the 8 weeks, which is precisely the day you got the money plus 55 days. It's a cash basis reporting, which means if you wrote the check, it counts. So that's probably enough on the PPP loan.
But I want to say one thing. Could you go back and say again what you just said about the income is not taxable, but the expenses are not expensable?
They're not deductible. That's right.
Not deductible.
So if you got $100,000, Rhonda, and you used it for all proper things that were allowable, you used it on payroll and you used it on rent and you used it on utilities, and you spent $100,000, when you go to do your tax return, you don't report the $100,000 you got under the PPP loan program, but you also don't deduct that $100,000 of expenses.
Which makes sense. That's
right.
That's how it should be. Yeah, because then it would be double dipping for sure. Yeah.
It was not clear when the program was announced originally. I just want to clarify to the audience that is what has been determined subsequently, along with many other rules that have been determined subsequently regarding the PPP program.
Yeah. Well, that's good to know.
And for those people out here who might have gotten some Health and Human Services money, HHS funds, those were automatic deposits if you billed Medicare at all. And I think you said your audience probably doesn't do a lot of that. But if they do, they did get some money automatically deposited in their account. We were under the impression when that happened that was going to be money that was not going to have to be repaid and had no real parameters. But we've subsequently learned that it cannot be more than 2% of your income from 2019. If it was, you need to return the excess.
More than 2%.
Right, more than 2%. They had a second wave of HHS loan funding, which kind of brought this to light because it basically suggested that you were going to have another opportunity to get even more money if you simply applied for it. But as that application was being rolled out, they also announced that, oh, by the way, the limit is 2% of your income from last year. So from all payers. So it may not be a wise thing to pursue that second round of HHS funding for anybody.
Right. So for those practitioners, for those of you listening or watching, even at a later date, if you did get that money and it's before, what'd you say, Bill, May 7th?
Well, the PPP money deadline is
up to 2% of your taxable income from the prior year.
The gross income from last year.
Yeah. Okay.
So those have some tax flavor to them. They're more germane with regard to the COVID-19 programs that we're all working under these days, but I figured your audience might want to hear that.
Yeah. All right, man, if you guys aren't if your brains don't hurt, mine hurts, and I've already So I've got my phone right here, see, and I'm looking at that's just the weirdest thing, isn't it? So anyway, I'm going to go through these and ask you, if you don't mind, Bill, we've got some questions.
That's quite all right.
Someone's asking, is there a better time of year to change from a sole proprietor to a corporation?
No, not really. I would say that what you'd like to do, if you could, is as early in the year as possible. You want to do that because the sooner you do it, the sooner you can start to take advantage of the programs we talked about tonight and the transacting with yourself, so to speak, that we are fond of and think is appropriate. So sooner is better than later, but no, there's no magic time.
So then, so if practitioner watching this and they want to switch and they're a sole proprietor and they want to switch over to an S corp, LLC, S corp, whatever, that it's fine to do it anytime. There's no reason why you couldn't do it, but you just didn't get to take advantage of the tax benefits for the first part of the year.
To form the entity itself, Rhonda, probably takes a couple of weeks most of the time, depending on what stage you're in. And then you secure an ID number, get an account opened. It takes probably 2 to 3 weeks to get the business up and running under a new type of entity. Now, if you already have an LLC or a PLLC and you want to simply treat it as an S corporation because of what you heard tonight, that's a very simple process. You simply file a form called a 2553, and you can convert that even retroactive to January 1st if you want to.
Yeah. But that's where you need to get with your accountant to get some guidance and make sure that you're making the right decision. And you wouldn't want to just be going off rogue and downloading a form from the IRS website and filling it out and turning it in without a little guidance.
Yeah, we recommend you get counsel first to make sure it fits your situation. Most of the time it will, but there may be circumstances where it doesn't.
Yeah. All right. So someone else is asking, how can we utilize these tax strategies with a joint return with a spouse?
Quite easily, because the strategies we've talked about tonight are related to the entity. And when the entity return is done, the S corporation return or whatever type of return it may be, it's going to produce a document, typically a K1, and that K1 is going to flow through to a personal return. So all the strategies can be executed at the entity level, and that affects the K1 of one of the spouses. And then whatever the other spouse brings to the table in terms of taxable income is simply going to be added to the K1 to determine the family income.
Right.
So at least it will have driven down taxable income for the family unit.
So just to be clear, for those of you that don't understand that, so a K1, when you have a corporation, a K1 is produced, and that is basically like it's the income that the shareholder gets at the end of the year after everything's all been fussed out and you've taken all the tax benefits and all this, that, you've expensed everything. And that's what ABA Advisors is so good at, Bill and his team. So at the end of the day, when all that is all sussed out, you get this K1 document, and that's basically tells you what you're personally responsible for as far as tax goes. So that goes into your personal income, that K1 document.
And let me just suggest another piece of that that's really important, and that is prospective planning. I hope the accountants you guys are working with are looking forward and not backwards. It's really important if you have clients that are using this kind of strategy to be able to forecast where they're going to be at the end of 2020, and be coaching them along the way about how to manage that tax burden so that they don't have surprises at the end of the year. There's no reason why any accountant can't tell you today on May the 4th what your income roughly is going to be for 2020, even with COVID and all those other things in play. And that's important to know because that's the goal you're shooting for in terms of making sure you have enough tax on deposit.
Right. Yeah, exactly. A couple people are asking about showing your website again, so I'm going to put that up, but I'll keep asking questions. So how does lower income affect Social Security amount for retirement?
It has an impact on it for sure. But think about that in the big picture of things. I mean, the maximum Social Security benefit's about $30,000 a year. And so if you cut that in half, but along the way, you did so by saving thousands and thousands of dollars every year in income tax. And so because when you retire now, you get a little bit less, you got to measure the trade-off. But most of the time, it's a landslide in favor of income tax deduction.
I couldn't agree more. Okay, so how do we go about changing from an LLC to an S corp?
It's very simple. You file a 2553 election form for the LLC.
Yeah. Okay. Do you help coordinate and then file both personal and corporate returns?
We do. We don't require doing the personal return. We prefer to, but some people have accountants in their life they want to continue to work with. So we do just the entity level, but we prefer to do both.
Yeah. Okay. One of the practitioners is asking again, can you redefine what an SEP is?
A simplified employee pension plan. Mm-hmm. Be opened by any brokerage house or any bank. And you can fund up to 25% of your income into that plan and take a deduction for that 25% contribution.
Okay. And they would not be able to just do that on their own. They would have to go to...
You can go to basic Fidelity, Vanguard, Oppenheimer type websites. And
got it.
One of the choices of type of account instead of personal IRA would be a SEP or SEP IRA. And you could go online and do it yourself.
Okay, great. Let's see. A simple IRA is different than a traditional and a Roth IRA.
Different than both. A simple IRA is an employer-sponsored program. And so the employer would make it available to all their employees. And because they do that, and because they agree to match up to 3% of whatever's funded. Now, if somebody puts in 0, they get 0. If they put in 3%, they get 3%. If they put in 6%, they get 3%.
Yeah.
So that's how it works on a simple IRA. But that allows the employer or the owner to go up to these higher levels of funding at $13,500 and $16,500 respectively. A traditional IRA is going to be a much lower contribution amount, depending on your age, $6,000 typically. And then a Roth IRA is a non-deductible contribution, but has a tremendous advantage in that it's never going to be taxed when it's taken out. And other IRAs are going to be taxed when they're taken out. So the Roth IRA is wonderful, but there are income limits. You have to be below a certain income level to be able to fund a Roth. However, if you're over that income level, then there's something called a backdoor Roth. And what that's about is you fund a non-deductible IRA. So you don't take a deduction for it. It's a traditional IRA. And then the next day you roll it over to a Roth. And then basically you've been able to contribute to a Roth.
Backdoor. Well, that makes sense. Okay, let's see. For those of you that want to make sure you get the free resource from Bill and ABA Advisors, be sure that you opt in for this because we need your email to know where to mail it. So you need to get on that list. It's in the chat. Okay, let me make sure. Hang on with me here. I'm looking at my phone.
Sure.
Yeah, one of the docs is asking about the clarification about 25% of the PPP being used for utilities and then 75% for payroll, but you covered that.
Well, no, we really didn't. Let me talk on that for just a moment.
Okay.
The area of confusion and one that's very important. So when you have the PPP proceeds, whatever of those proceeds you use, either the entirety or whatever portion you use, at least 75% has to be used for payroll costs. Now, payroll costs are broadly defined as gross wages, as group health insurance, and retirement contributions. All those count. However, nobody can count more than $100,000 of wages for annual salary purposes. So if you look at the 100,000, it's an 8-week program. You have the 100,000 times 8 weeks divided by 52 weeks, which is $15,385.
Right.
Nobody can count, no matter how much you're paid, more than $15,385 during that 8-week program. But you add all that together with other gross wages and your health insurance and your retirement funding, and that has to be 75% or more of the total amount that you used.
Got it.
A couple caveats real quick on that. Nobody can have their pay reduced by more than 25%.
Right.
If they make less than $100,000 during the time frame. And then lastly, whatever full-time equivalents you put on your PPP application need to be the same number of equivalents or more that you have during the 8-week period.
Right.
That doesn't mean you can't hire people, family members included, as long as they have a real job. But we need to get the FTEs up high enough to be greater than or equal to the same number as the application.
Right. And FTE is full-time employee. So we need to make sure that we've got enough full-time employees to be able to justify the distribution of the funds.
And that's been defined for us as well as 30 hours a week.
30 hours. Yep. Good. Okay. Some of this we've already covered. Can you stay a sole proprietor and still file tax under an S corp, or do you have to be an LLC?
No, you can be a sole proprietor without any entity whatsoever.
Yeah.
Or you can be a single member LLC, which basically makes you a sole proprietor.
Right.
So they're one and the same, essentially.
Right.
The only reason that people form LLCs is for liability protection in that situation. But if you form the LLC and you're still a sole proprietor, in my opinion, you've missed the biggest opportunity for tax minimization, which is simply to separate yourself from the entity and begin to transact with yourself.
Right.
But for the sole proprietors on this broadcast, you guys know that every dime you make is subjected to both income tax, federal and state, along with self-employment tax, every penny.
So
and
expensive.
That's sole proprietors. So I don't know. I mean, there may be reasons why somebody would want to be a sole proprietor. I guess avoiding accounting fees and legal fees might be one of them, but those are not very significant compared to what you're giving up as a sole proprietor.
Right. Yeah, exactly. I agree. So someone's asking if you work with people in all states, and I did forget to mention that at the beginning, but yes, Bill and his team have clients in all 50 states. So it doesn't matter where you live. So he can work with you. I live in Nevada and Las Vegas and have been working with them for a long time. So my advisor lives in Tennessee. Bill lives in Tennessee. The person who does my accounting, I think she's in Southern California. So they kind of have a team of people all over the country. And so they know the laws in the different states and are adept at being able to do that. Okay, when you do SEPs, don't you have to give every employee a contribution? Is it based on their wages? And can you set up a 3-year waiting period for employees, but allow the officer to get money in the same year?
That's a lot of questions.
It is a lot of questions. And so do your best with that.
Everything that person contended was essentially correct.
Yes, okay.
SEPs do include other employees, but they have to have worked for you for 3 or more years, and they have to have made more than $500. If they're in that situation, they too get whatever percentage contribution you gave to yourself, you have to give to them.
Okay. So we've got some questions. You guys are doing awesome, but we've got Shayna just jumped on, my assistant, and she said there's a bunch of people that are asking questions on YouTube because we've got this kind of broadcasting everywhere. So she just sent me a list of questions. She sent me the link. Hang on, guys, because I want to make sure that on YouTube, because we've got this. Can someone collect unemployment while PPP is in the bank account waiting for their office to reopen?
Yes, if they've not been paid. The way unemployment works, unemployment is paid by the state government typically. But in this COVID-19 era, the federal government decided they had $600 a week to whatever the state's paid, which, as an aside, created havoc because now we have employees who are making more money on unemployment than they were being employed in the first place, and that was not a very good idea. But the answer is yes, they can collect unemployment. So every week when you're collecting unemployment, you report your earnings for the week. So if the employee has not yet received a PPP, or a check from their employer, regardless of why, whether the PPP funded it or not, if they've not gotten a check from their employer, they're eligible for unemployment that week. If the next week they get a paycheck, then they have to report that, and their unemployment benefits may be diminished or may go away altogether. When they get a paycheck. That's how it works.
So they don't have to close their quote unemployment claim. They have to just report their wages, and then that stops any further payments because they got wages.
That's right. Or maybe it reduces them if it doesn't stop them entirely. That's right.
Okay. All right. Someone else is asking, what strategy would you utilize to save for the down payment on a house? Let's say 10% down or up to 100,000. Would you use distributions? And this person has an S corp.
Okay. Well, clearly distributions are favorable over salary because salary is not only subjected to income tax like distributions are, but it's also subjected to Social Security and Medicare tax. Right. So I would tell them, step one, I would minimize salary, but it has to be reasonable, and take dividends out of their S corporation as well. If they have children, I would consider having the children become owners in the S corp and take the distributions and carve them up between the parents and the kids because the kids' tax bracket is so low. I would then have the kids gift the money back to mom and dad, tax-free, to go towards the down payment. You know, we talk about gifting to children all the time. How much can we give to children? It's $15,000 a year without impacting your lifetime gifting allowance. But kids can give to parents the same way. So each kid can give both parents $15,000 a year without tax. So accumulating money for the down payment by utilizing children or siblings or parents with a lower tax bracket would be very shrewd. Outside of that, there's a possibility of putting the money in a 401k, taking a deduction for that money, and then borrowing from the 401k for the down payment. It used to be you could borrow $50,000 or 50% of your 401k balance, whichever was less.
Right.
And the rule changed with COVID-19 to $100,000 or 100% of your equity, whichever is less. So it would be nice to get a tax deduction along the way while you're accumulating money towards the down payment.
Right. Yeah, that's a great strategy, and that's a really great question. I'm really glad that was a YouTube question. So thanks for asking that. Let's see. I'm not, there's a question, but I'm not quite sure I understand it. So I think we probably have reached the end of all the questions. We've had a good turnout for this here and on Facebook and all over the place. So you've got Bill's email address right here at the bottom. Thank you all so much for joining me for this first night of our Live at 5 with Friends. The rest of the week is going to be this good and better. I will tell you, though, this is probably the most cerebral you'll have to get.
Well, Rhonda, can I close with one quote?
Yes, please.
You asked me also among the questions before we had our meeting tonight, why is it okay to minimize your taxes? And I'm obviously a passionate believer in bringing the advice to the table. But I want to quote from Judge Billings' learned hand, because he said it well. Anyone may arrange his affairs so that his taxes shall be as low as possible. He is not bound to choose that pattern which best pays the Treasury. There's not even a patriotic duty to increase one's taxes. Over and over again, the courts have said there's nothing sinister in arranging your affairs so as to keep taxes as low as possible. Everyone does it, rich and poor alike, and all do it for the right, because nobody owes any public duty to pay more than the law demands. Good night.
Thank you so much, Bill. That was a perfect way to end. Thank you, friends, for hanging out with me tonight. We'll be back tomorrow night at 5 p.m. Same channel, same, with another great guest. So thank you all so much. Have a great evening. And Bill, thank you again for sharing so much of your great knowledge with us.
You're welcome.
Thank you. Good night, everyone.
Good night.